from the financial centers of the world. This is Bloomberg Markets with Alix Steel and Guy Johnson.
Thursday the 7th, 3 p.m. in London, 10 a.m. over in New York. That means it's 30 minutes into the trading day. I was trying to remember where Alex was. I'm Guy Johnson in London. Alix Steel is over in New York. This is Bloomberg Markets. I'm not entirely sure what happened there. Maybe I'm just shocked, Alex, by the fact that, unsurprisingly, we punted the debt ceiling football. Energy prices are coming down. Vladimir Putin can maybe take a little bit of credit for that. Equity markets feeling a little bit calmer.
Yeah, it really feels like Putin and McConnell came out and calmed all the markets. Like, that was my takeaway from the last 24 hours. It's an intermission, though, because none of the problems are actually solved. Cans are just being kicked down the road. The S&P, though, managed to get up by 1.3%. All the cyclical sectors like materials, industrials, financials, they're all leading the way higher. Energy, the underperformer, although still green in the space, as oil kind of takes a little bit of a break as well, hence the whole Putin calmed the energy market. The NASDAQ up by 1.4%, so that moving higher. You got tech and you got cyclicals all moving up. At the same time, though, you still have yields moving higher here in the U.S., up 2 basis points in the 10-year. On a closing basis, this is the highest level we've seen since June of 2021. VIX also now below 20, but it's like, what's going to happen in 8 weeks? What's going to be different? I really wonder if the same conversation is going to take place in just a few more weeks.
Yep. We've kicked the can down the road, we punted the football down the field, but have we actually ultimately solved the problem? That is a question that I think we need to talk about. Well, let's figure out how we're going to do all of this and figure out the answers to some of these questions. We're going to take you to the centers of action, basically. These are the main stories we're following. Emily Wilkins of Bloomberg Governments has got the latest on the debt ceiling showdown. And we're going to talk to Ira Jersey of Bloomberg Intelligence about exactly how markets are pricing the risk, even if a default has been averted for now. But are we going to get a ratings downgrade? Mike McKee here to break down this morning's initial jobless claims numbers and look forward, of course, to the payroll number tomorrow. We've got a live shot of the Senate floor. We need to talk about what is happening there. We are nearing a deal on that short-term increase in the debt ceiling that will effectively pull the U.S. back from the brink of that payment default. But have we actually avoided that? Emily Wilkins of Bloomberg Government joining us now to discuss that very subject. Emily, is that the case? We've kicked it down the road. We don't know what the solution is. I don't even know what the details of the short-term solution ultimately look like. Can you tell me what's going on?
Well, we don't know what the details of the short-term solution look like either. I mean, late last night, Senator Chuck Schumer, the top Democrat, came to the floor, said they were still working out the details of what this deal is going to be. We're expecting to hear more about that this morning. It's just a little bit past 10, so that means the Senate has just formally started their session for the day. Lawmakers are hoping that there can be a vote today. Senators are actually supposed to head back home to their districts and be there for the next week. So lots of questions about what this is going to look like. But you guys are absolutely right to point out the fact that this really doesn't resolve anything. Republicans say that they will not be voting for a long-term increase of the debt limit. Democrats are continuing to say that they do not want to use that reconciliation process, which would require them to actually name how much they want to push the debt limit up. Both of them are worried about potential electoral consequences in next year's midterms. And at this point, it's not really clear how this gets resolved. It's just really a question of how much time do we have to potentially come to an agreement.
Exactly. Uncertainty's still there. Emily, thanks a lot. Emily Wilkins of Bloomberg Government. So let's turn to that market reaction. You got CEOs, including JP Morgan CEO Jamie Dimon, sounding the alarm on a potential catastrophe in case a deal to raise the debt ceiling isn't increased. He met with President Biden and Treasury Secretary Janet Yellen.
Number one is really a morality point. We all teach our children that we're supposed to meet our obligations. I don't think the nation should be any different. Number two, we should never even get this close. There are huge economic costs already being borne by companies and lawyers trying to figure out what this means if something like this ever happens. It's already affecting the stock market, et cetera, as you heard from some of the folks here. Number three, we should get rid of the debt ceiling. We don't need to have this kind of brinkmanship every couple of years.
And even if the U.S. does avoid default, what kind of reputational damage has been done? Joining us now for a market take here is Ira Jersey, a rate strategist for Bloomberg Intelligence. Ira, what we learned, debt ceiling does matter. You need to price it in some way. The repo market's already showing it. How do you do that when there's no drop-dead date?
Well, there's a couple of different ways, and you're seeing it in the market. So if you look at short-term credit default swaps on the U.S., those have spiked very significantly over the last couple of weeks. And if you look at a 6-month or 1-year CDS, those have really inverted significantly, because there are people who are worried that there might be a technical default at some point in the near future. And like you've mentioned several times, this just kicks the can down the road. So one of the market reactions that we're seeing now is those T-bills that are in that late October time period, they're starting to rally a little bit. They'll lower yields for those bills. But then the early December bills, those have started to widen out a little bit, and yields are a little bit higher. Not a lot yet, but it will be coming. I think that if we do get another standoff, that you will have more market angst. You're likely to have significant volatility in equity markets and the like. I don't think this leads to a downgrade, because ultimately this is about the 5th time that we've done this over the past decade, and every time Congress does raise the debt ceiling. But quite frankly, I'm not always in Jamie Dimon's camp. This time I am. I'm tired of the debt ceiling. It's not something we should talk about. So, permanently suspending it would be something I think that markets would like. It would give a lot of certainty to make sure that we don't have these kind of fights every couple of years, especially since this isn't a budget fight. This is just whether or not we're going to pay our bills. Have the budget fight separate from this.
Be interesting to see whether the rating agencies have already seen enough maybe to change their view of the United States as well. We've seen that in the past. Ira, always a pleasure, always insightful. Thank you very much indeed. Ira Jersey of Bloomberg Intelligence. Let's stick with risk and talk about some of the others that we need to think about and where we may see some breathing room. This morning, we get a little bit of more positive data out of the United States, and it's focused on the labor market. U.S. weekly jobless claims retreating last week to the lowest in a month in a broad-based decline. This ahead of payrolls, of course, tomorrow. The big number we're going to be focusing on here to talk about it all, Bloomberg's Mike McKee.
Well, Guy, these numbers aren't going to change anybody's mind about tomorrow, because they do come after the survey period, but they are reassuring in this way. We saw jobless claims for the last month, including during the survey week, rising, and that wasn't what people expected to happen, and now they've gone back down again, so that's reassurance that the labor market probably continues to heal. This is the number of people, the total number of people who have been getting benefits. That's the cliff that they hit September 6th when the extended federal benefits went away. So all those people not getting benefits anymore, there's a feeling that they're going to end up in the labor market, if not all of them this month, but next month, and we may see relatively strong job gains. Here's what we're expecting for tomorrow, and there has been a change in the total number. It went up from yesterday to today, probably due to ADP, but we're at 500,000 now. It was 488 yesterday. That would be roughly double the August number, and that should be good enough to keep the Fed on track for tightening. Unemployment expected to fall a tick as the participation rate goes up by a tick. And if the participation rate goes up, it makes it harder for the unemployment rate to come down, but it means more people available for jobs, and there are a lot of job openings in the economy. So at this point, it looks like we're set up for a decent payroll report, and that's what Jay Powell and the Fed are looking for.
Yeah, it's going to be fun tomorrow. Okay, let's get to some breaking news. Lyle Brainerd is commenting in his speech talking about the impact of climate change on the economy as well as businesses. And in it, she says that climate disclosures should ultimately be mandatory, and that supervisory climate guidance for large banks may help, and that new climate disclosures will be needed. My quick question, what do you make of that? What is she trying to do here?
Well, there's a couple of interesting points here. First of all, this was an unscheduled speech, and there's been a lot of talk about who's going to get what job at the Fed. In this speech, she makes the point that climate change could have important economic effects. In the past, we've seen, a hurricane come, and then we get a rebuilding, and it kind of disappears from the data. But this could be a long-term impact on the economy, and it could really affect financial institutions, not just banks, but insurers who insure property and things like that. So the Fed has a role in doing this. It also comes up at a time when Randall Quarles, the Fed vice chairman for supervision, is about to leave. Next Wednesday is his last day as the vice chairman for supervision. Does this mean that she's angling for the job? She's making the point that we should have these as part of the stress test. Jay Powell has said they shouldn't be part of the stress test. We should model climate scenarios, but don't make them a requirement in terms of whether you can distribute capital or not. So an interesting dynamic, an interesting sort of split on the Fed here.
Elizabeth Warren really has set the cat amongst the pigeons on all of this, hasn't she? Some interesting decisions to be made over the next few weeks. Mike McKee, thank you very much indeed. We're going to kind of carry on a little bit with that environmental theme, that climate concern theme. Aniket Shah, Jefferies Global Head of ESG and Sustainability, is going to be joining us a little bit later on. Is the energy crisis that we're currently seeing around the world, particularly here in Europe, going to slow down government calls for that energy transition? Is it going to affect ESG? OK, coming up, we're going to talk more about these markets. Jonathan Golub, Credit Suisse Chief US Equity Strategist, joining us next. This is Bloomberg.
We are starting to experience elevated volatility in the markets, which can be partially attributed to the uncertainty that's been introduced by the delay in approving the extension of the debt limit. We would expect that a continued delay in extending the debt limit would further destabilize the markets.
Adina Friedman of the NASDAQ talking at that summit yesterday, bringing business leaders together to talk about the way forward. The S&P getting a bit of a boost today, Alex, hitting the highest level in nearly 2 weeks. Abigail Doolittle looking at the lift and why we're seeing it.
Well, Guy, indeed, today's volatility is to the upside, and that's an important point. In times of volatility, it's not always to the downside. There can be big moves to the upside, and we're certainly seeing that today. The S&P 500 heading to its best day since July 20th. The NASDAQ up 1.5%, its best day since August 23rd. And the Russell 2000 getting a solid bid, the index that underperformed yesterday because these other indexes up 3 days in a row. The Russell 2000 down yesterday, up 1.6%, its best day in almost a week. As for the volatility that we all know, it's been up, down, although again, the S&P 500 heading to a third up day. Here's a 10-day chart of the S&P 500 E-mini futures, and you can see here's the decline that led to this feeling of volatility to the downside, but lots of chop, and now the S&P 500 trying to go round trip, essentially erasing that loss, right now down just 0.5%. Now, if we take it broader, this time period, and it's interesting because we have this debt ceiling debate, is starting to look a little bit similar to 2011 relative to the charts. We have this beautiful uptrend. 2011, of course, was the rally of QE2, but you can see here this choppy time period. That happened in 2011, too, as traders tried to figure out what was happening around the debt ceiling limit. Ultimately, it was raised, but the credit rating for the U.S. was downgraded, and it did lead to a correction. We don't know that that's the case, but this action here between the 100-day and the 50-day moving average, it looks uncertain, tentative at best. It will be very interesting to see what it does lead to. But today, Alex, we do, of course, have these very solid gains for the major averages.
Yeah, it was a fascinating kind of 72 hours there. Abigail, thanks a lot. Really appreciate it. Let's get some more insight now. Jonathan Golub, Credit Suisse Chief U.S. Equity Strategist. He has a $4,600 price target on the S&P and 500 for 2021. Sorry, 5,000 for 2021 and 5,000 for 2022, if I'm reading that.
4,600 and for this year and 5,000 for next.
Ah, got it. Okay. I gotcha. Okay. That was me not reading prompter. I got to get my ass checks. Okay, so Jonathan, talk to me then about the volatility that we've seen, because there were like two schools of thought. You got the Morgan Stanleys of the world that are like, we're just in this correctional phase here. It's a mid-cycle transition. And then you have the JP Morgans, which is guys, you want to buy the dip. Where do you sit?
I don't want to say I sit closer to JP Morgan, but somewhere in the middle. I mean, first of all, let's look at what actually set this thing off. The market volatility really started on September 22nd when Jay Powell signaled that they were likely to taper starting in November. And if you look at, you got a 20 basis point rise in interest rates, and then you started to get chopped up in this market up and down, up and down. If you look at the last time we had a large rate increase was last November, but that was a very different setup. We had the vaccine announcement and we were passing additional stimulus measures, and interest rates were going up because the market was seeing better economics. Now we're starting to see some weaker economics, and we could talk about that, but on a weaker backdrop, you now have the Fed saying we're going to taper, and that's what's pushing up interest rates. So the cause of the rate rise is really the big difference between now and a year ago.
Okay, so let's say that we see rates continue to go higher from here. that we get a decent number tomorrow. The taper's on track. We see this inflationary story persisting. It was interesting, the Bank of England's new chief economist talking about it lasting longer, and rates continue to climb. But this is cost-push inflation that effectively is moving this. Jonathan, where do I want to be in that scenario?
Right. So if you assume that the interest rates are going up because you have a healthy economy and not because the Fed is acting in a more hawkish way, you want to be, first of all, you want to be long stocks because a better economy is good for the market. And you want to be in cyclical companies. These are companies that are more economically exposed. Right now, they're trading at a huge discount to technology, and they're delivering better growth. The value benchmark is expected to deliver faster EPS growth than the growth benchmark each of the next 4 quarters. So good economic news really pushes that value trade hard.
Jonathan, hold your thoughts. I want to take everybody over to the Senate right now. Chuck Schumer is speaking. I want to take a listen to what he has to say.
It looks like we just missed it, Guy. But Schumer did say that a deal has been reached. We're doing really well today. That a deal has been reached for a short-term debt deal. That's the headline that we have. We will have to see what the timelines are and any other sort of questions that we have. In particular, what happens now? What kind of leeway does this actually give them? And more importantly, can they replenish the funds that they use to get us to this point, to October 18th. Jonathan Golub of Credit Suisse still with us. Hey, Jonathan, even if you think the debt ceiling is a non-starter for you as an equity strategist, it does bring up the question of where do you hide? Where do you get a little safety if you need it?
Well, it depends. First of all, if you think things are really going to go wrong, then the strange thing is you have no choice but to go into U.S. Treasuries, because for all of this hoopla about us potentially defaulting, which we're just not going to do, the Treasury is still the safest place on earth. But within equity markets, you would buy consumer staples and healthcare. But like you said, Alex, I mean, we've been looking at this for the last decade, where every couple of years there's this debate and everybody predicts the end of the world. And at the end of the day, folks in Congress basically make this go away. And that's what equity investors are seeing. Bond investors are much closer to this and watching every move. Equity folks kind of roll their eyes and say, come on, we all know that this is not going to happen. And let's just get back to things. So if you look at the market risk, I think the Fed tapering is a market risk. I think the jobs report tomorrow is a market risk. Earnings season is a market risk. But the debt ceiling, probably less so.
Let's talk a little bit about what's going to happen with earnings. This is going to be the next challenge that we face. We seem to be moving maybe beyond the energy crisis, maybe we're moving beyond the debt ceiling, or we've just parked both of them for the time being. Who knows when they're going to ultimately come back. But earnings are next, and that is certainly something that we need to think about post-payrolls. Jonathan, what I'm trying to work out is there's all this pressure in the middle of the P&L. Margins are going to be squeezed, we know that. But my question to you is the top line going to be strong enough to compensate?
So first of all, I'm going to disagree with the way you're talking about this and the way it's being characterized. Margins aren't being squeezed. Costs are going up. And if you have your costs go up, but you're able to pass those costs on, you don't get a squeeze on margins. You get a squeeze on costs. And the thing which people forget is that a big chunk of the cost of big public companies are fixed overheads. They lease equipment, they have equipment that they depreciate over time, and those don't move up and down with the cost of oil or labor. So in an inflationary environment, if you look at the last 5 quarters, we've seen enormous earnings surprises. The average company beat by 19%, and almost all of that surprise was on the margin line, even though costs were rising. So yes, companies are going to complain about costs, but I think we're going to be surprised that margins are going to expand this quarter, not go down. And I agree with you. Actually, I think the question is how strong is the revenue line?
Yeah. So how strong will the revenue line be? Because some say that instead of being a cost-push inflation like I was talking about, it's a demand-pull inflation story, that the demand's just really there and the demand destruction hasn't been happening yet. And you can see some of that in the survey data, like the services and manufacturing data. When do you think we might see that kind of demand destruction, or do we not at all?
Yeah, I don't think, Alex, well, there's two issues. But one is you talk about something where because prices are higher, I say, yeah, you know what, I don't want to go out to that restaurant. It's expensive. I think the bigger issue is I want to buy a car and there's delays. I can't get delivery of it. So there's demand for the vehicle. There's demand for me to go on vacation. There's demand for me to go and spend. And the delivery is backlogged. And I think that's probably what's going to hold things back. If you look at, I pull this up regularly on my Bloomberg terminal, GDP now shows that the expectations for this quarter of GDP have been weakening a little bit.
Yeah, I totally take your point about delivery inflation. That certainly seems to be the story. You can get it now, the price is the same, but you have to wait for longer. So there's two types of inflation certainly in the system. Both, I would argue, potentially are going to slow down economic growth and be a drag. Jonathan, always insightful. Great to get your take on what's happening with these markets. Jonathan Golub of Credit Suisse, greatly appreciated. Let's go back to the Senate floor. I don't think I've ever seen Chuck Schumer speak that quickly. We missed him. I apologize for that. But nevertheless, we're not going to miss Emily Wilkins because she's here now with the details. Emily, it was an incredibly short statement. A, why? And B, did we learn anything from it?
Yes, we learned that there is an agreement, that the agreement will go until early December, and that's apparently all the details that Chuck Schumer has to offer us right now. We are waiting to hear more details about exactly what this agreement will look like. One thing we'll be looking for, do they name a dollar amount as far as a temporary debt ceiling raise? Do they put a time limit on it? As well as just trying to figure out how many Republicans might go along with this. I mean, they have to have 10, but it will be interesting to see if the other 40 Republicans wind up supporting this short-term measure or not. So I think we're going to be taking a look just as this story continues to unfold. We are expecting a vote today, which means that senators get to board all of their scheduled flights and fly back to their home states. But at this point, and we're also seeing the Dow going up at this point. So it seems like we are going to be able to avert defaulting on the debts on October 18th. And now we have a showdown set for early December, which, if you remember, is when the U.S. government is currently funded through. By December 3rd, we'll have to have a new plan for spending the U.S. government and a new plan on raising the debt limit.
Yeah, S&P at the highest session. But as you point out, those twin limits, which we were just dealing with a few days ago, back in focus. Something that I was also interested in, do we know if they're going to let the funds that they had to use to get us to this point to extend payments? Do we replenish those funds? Because that's also going to matter in terms of when that drop dead date actually is.
That is a great question, and that's one that reporters have been asking since last night, trying to get a sense of, does early December mean early December, or is it actually more mid-December, late December? How is that going to work? I think once again, it's going to be something, this is truly breaking news. I mean, people who've been watching the show saw me on here, 15 minutes ago saying we don't know yet, and now we know something. It's very much developing, and we'll definitely be keeping Bloomberg audiences informed as we begin to know more.
In terms of the impact that this is going to have on the other aspects being debated in D.C. at the moment, and I'm talking about both the physical and the human infrastructure programs that the Biden administration is trying to push through. We've seen the Republicans, McConnell, slowing things down effectively by what he's been doing. Does this continue that process of meaning that the Democrats have got to focus here rather than focusing over here on where they want to spend their time?
Well, if you ask lawmakers, they always like to say that they have the ability to walk and to chew gum. So I'm sure there will be some who will continue to work on the debt limit. And I mean, even this week, it hasn't been big in the headlines, but President Biden did hold 2 separate meetings with groups of lawmakers, asking them what their bottom line is going to be. I've spoken with lawmakers' offices who say they're in touch with the White House every day on what this social spending plan is going to look like. I think in the minds of Democrats and lawmakers on Capitol Hill, their new deadline for this social spending plan is October 31st. And so that does mean that that's a little bit closer now than the debt limit. But let's be clear, both of these issues are very tricky and difficult in their own way, and it's going to be taking some time for both of them.
Yeah. Emily, we got to leave it there. Really appreciate the hustle. Emily Wilkins of Bloomberg Government joining us there. Again, Chuck Schumer says that the Senate should vote on extending the debt ceiling limit till December, sometime later today. This is Bloomberg.
the amount that's going to be required to transition from our fossil fuel economy to the clean energy economy is very dramatic. It's probably the largest amount of money that will ever get spent in infrastructure over a 25-year period.
That was Bruce Flatt of Brookfield Asset Management, a CEO, talking about the energy transition that everybody is underway. How does the recent spike in power prices and natural gas change that conversation, if at all? We want to get more on that with Aniket Shah, Jefferies Global Head of ESG and Sustainability Research. It has been a very difficult few months when it comes to power prices and natural gas prices if you're a consumer at home and have to pay some bills, and particularly if you wind up removing a cap. Does this change the public will towards energy transition? Do we need to slow it down?
If anything, we need to speed it up. What we are realizing, of course, is that the world remains fundamentally addicted to fossil fuels. That has risks that are associated with it. The investor community is very interested in financing an energy transition, but it needs to happen in a coordinated way. It has to be done thoughtfully and over time. And I think what we're realizing right now is that these things are difficult. They require a lot more collaboration and coordination that's currently happening. But in our view and in the view of the ESG community, the short-term pressures are not a reason to slow down the energy transition. If anything, it means we should accelerate it, but we should do it in a thoughtful way.
What happens if government takes a different stance? What happens if government, worried by the fact that consumers, voters are ultimately having to pay more and are seeing their electricity supplies, their gas supplies becoming more and more problematic, and government decides that maybe we are going too fast? Is there a danger that the investment community is too far out in front?
I don't think there's a danger that the investor community is too far out front. I think the danger is that, frankly, governments haven't really thought this thing through. We really need national pathways to achieve a low carbon future. There needs to be much more thoughtful energy planning from major economies. The investor community needs to be behind long-term energy transition pathways, and the government needs to support communities and groups of people when there are fluctuations like the one that we are in right now. Now, how do the politics play themselves out? You know, I'm not a political analyst, but for sure, in the ESG world, we are oftentimes understanding consumer sentiment and voting sentiment. Mm-hmm. And the interesting thing is that people want an energy transition, but they want it to be fair. And this just, to me and to us, it really shows the importance of long-term thinking that isn't there right now from a lot of governments.
Sure, and you kind of all have to do it together or else it doesn't count as much. I mean, with China saying buy power at all costs, in addition to coal, that's going to create some problems. So for you guys over at Jefferies, how do you find the best, most properly valued opportunities?
As I said earlier, our view is always to think about the long term when it comes to sustainability transitions and ESG. This is fundamentally, the whole construct of energy transition has to be viewed with a multi-decadal mindset. And that's something that investors are not used to doing, to be honest, especially today. But the clients that we speak to are, and they're saying, okay, over the next 30 years, we need to transition the economy to a net zero economy. That means, frankly, $100 trillion plus of investments in capital investments across all kinds of technologies, sectors, and so on, in renewables, in storage, in batteries, in electric transportation. And that thesis has not changed at all. It hasn't changed because of short-term inflationary pressures or what are very serious energy issues right now in Europe and in China. The long term remains intact. I think for what we're seeing with our clients is a desire to have better and more thoughtful thinking from regulators on this energy transition, and that's what we're pushing for.
You talk about it being the need for it to be long-term thinking, but there is also a need to compress timeframes. If, for instance, we have the energy situation here in Europe, and you're saying that should mean that we should be accelerating what we're doing. What are the biggest blockages in terms of that acceleration process? When you're thinking about investing long term, but you're thinking also of picking up the rate of change, does that put you in a different place than you would have been if for instance, this energy crisis isn't happening and we were to continue at the original kind of rate of change? I'm just kind of wondering if you need to go to different areas, if we need to accelerate this.
Yeah, look, I mean, it's important to get some numbers straight here. You know, globally, the world still gets around 80% of its primary energy from fossil fuels. That number was only 83 or 84% 20 years ago. Renewable energy as a percentage of global primary energy today, globally, is the same as it was 10 years ago. So I don't even think that we are having an acceleration of the energy transition, right? If you look at total amount of climate finance, we're at roughly where we were a few years ago, with a slight increase, by 5 to 6% a year. So it's not as if the actual world economy is quickly transitioning to fossil fuels. In fact, what the energy crisis shows right now is that we are still very much a fossil fuel economy, and that if you underinvest in fossil fuels in the short term, which is what happened over the last couple of years, you're going to have these types of energy spikes. So we are of the view that you think, yes, you have to have the long term in mind, but then, as you say, the short term has to deal with these trade-offs. We have to deal with these trade-offs, and frankly speaking, a lot of this has to do with better investments from the state and a better regulatory approach that helps guide us.
Aniket, we're going to have to leave it there. Great stuff. Thank you very much indeed. Aniket Shah of Jefferies. Mitch McConnell's speaking now. He's still speaking, which is good news. So let's take a listen to what he has to say.
Placed by the Biden administration's desperate rhetoric of diplomacy. Putin is unfazed and undeterred. Repression at home, manipulation of energy markets abroad, military modernization, cyber mischief. This doesn't exactly scream ready for good faith engagement. Most of all, the administration's hollow rhetoric has done nothing to deter the growing threat from communist China. Just this month, Beijing has sent a record number of military aircraft on provocative missions into Taiwan's airspace. As senior Pentagon officials have warned, we're witnessing a strategic breakout by China. Democrats still refuse to let us adequately fund our own military and defense. The Biden administration's budget falls woefully short of our requirements for greater competition with China and with Russia. All the more so given the inevitable growing terror threat. And here in Congress, Democrats are doubling down on this reckless misstep. Democrats want to spend trillions of dollars on a socialist wish list at home while leaving the service members who keep us safe overseas in the lurch. Now, I don't expect Chairman Sanders or certain radicals in the House to be keen on using reconciliation to fund our military. Hardly.
Okay, Senator Mitch McConnell speaking. He was addressing the debt issue at the beginning of the statement that he's making. He's now moved on and talked a little bit about what is happening in terms of the geopolitical ramifications of what is happening in the energy markets. Alex, it's interesting that I find it fascinating that both sides actually have not spent much time in their statements that they've made today dwelling on the deal that is being done in terms of the debt ceiling. They've both gone through it really quickly and made very cursory statements about what is happening here. We've learned a little bit, but we haven't learned a lot. And it feels like odd politics to me that neither one wants to apportion blame or take credit for what is happening here in terms of getting this deal done. I sense that they're both kind of, this is a temporary truce. This is nothing more.
Well, it really depends on then how you're going to spin it, right? So you have Elizabeth Warren saying that McConnell caved, but then you have some analysts like over at Goldman Sachs who are looking at the Treasury market, and they're like, nothing's actually going to change. Like, it's not like all of a sudden the Republicans are going to come to the table. It feels like it's still going to have to go through reconciliation at the same time when they're still trying to work out what that final human infrastructure number is going to be, if we're going to be in that $3.5 trillion or less. So it does still feel like there's more uncertainties. We did learn, though, irrespective of what McConnell was saying, Department of Energy is not going to be releasing any stockpiles from the SPR. They're not going to limit exports. That was also a rhetoric that kind of permeated the market a little bit yesterday that calmed the energy prices.
Absolutely. And it's interesting that everything seems to be calming down at once, but you feel as if everything is just being kind of put on hold. The energy story isn't done. The debt ceiling story isn't done. The markets can breathe a sigh of relief for the moment that we've avoided a near-term deadline, but we're setting ourselves up for one further down the road. I feel like I've lived through this a number of times. The European debt crisis felt exactly the same. OK, what are we going to do next?
That's not a good comparison.
Launching... Yeah, exactly, because that ended brilliantly. Invesco launching 2 brand new crypto-related ETFs. It's interesting how they're structuring them. John Hoffman, the firm's head of America's ETF and index strategy, is going to be joining us next to talk through what they're up to. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Sheila Bair, the former FDIC chair. That's at 4:30 p.m. in New York, 9:30 p.m. in London. This is Bloomberg.
"44 minutes past the hour, live from London. I'm Guy Johnson. Alix Steel is over in New York, just to be clear about that. This is Bloomberg Markets. Alex, I nearly got it wrong at the top of the show. Invesco, one of the largest ETF companies in the world, has created 2 new ETFs, and they're designed to track crypto markets and do so more closely. With Bitcoin hovering around 55,000, the question is, will more ETFs bring more price movement? Bloomberg's Sonali Basak setting us up.
Yeah, absolutely, Guy. Look how lucrative of a trade it has been to be in Bitcoin. Despite the volatility, you have really seen a more than 80% rise year to date, and we are hovering right around, right around 55,000 now, which is much higher than anybody at the beginning of the year thought it would be by this time. Then if you take a look, though, at the derivative plays on Bitcoin, take a look at the Grayscale Trust, which is the most really highly watched measure of these derivative trades. It's up more than 30%. So there's a question out there about whether you hold these derivative plays, whether they're safe or more secure, or whether you invest in Bitcoin itself when you see those types of price movements. If you look one other level lower, you have another derivative here. You have, for example, ARK's Innovation ETF. They have a fintech ETF as well. We know Cathie Wood believes in cryptocurrencies, blockchain technologies as a key game changer to financial services. This is up about 3% on the year. So if you invested in the physical itself, you would be up much higher than the derivative plays, which leads you to wonder, what is the purpose of them?
Right, that's such a good point. Right, just by the underlying rather than all the other fees that may be associated. Great stuff. You're sticking with us. So Invesco's new crypto ETF and the landscape more broadly, we're going to break that down now with John Hoffman, the firm's head of America's ETFs and index strategies. John, let's just pick up where Sonali left off. If you can outperform with just straight up Bitcoin, why do we need all these derivative products? What's the thinking behind it?
Yeah, absolutely. And there are quite a few ways to access the asset class, and there continues to be more funds launching to provide different exposure. I think if you take a step back, blockchain is a revolutionary technology, and we're in the early days of this. So if you could flash back to, the late 90s and think about the internet back then, I remember dialing up on a modem, and now I can swipe my phone and have a package arrive at my door 25 years later. We're at the early days of this blockchain evolution, if you will. And so today, as you mentioned, Invesco has expanded our offering. We launched 2 blockchain ETFs, one that is broad, investing in the whole ecosystem, the publicly traded companies that are building this world, and then one that's more specific, ticker SATO, S-A-T-O, which is really geared at the companies building the cryptocurrency part of the economy. And again, there's many ways, as you point out, to access this new and emerging asset class, and we expect there to be a continual evolution of more product to allow clients more choice to access these markets.
Absolutely. John, and at some point, we're going to get deep into the world of crypto ETFs. At some point, the regulators are going to clear it. What happens to these products then? Are these just holding place markers for when that happens? What happens to these kinds of ETFs when we get that clearance?
Yeah, not at all as in terms of a placeholder. So we have an analog here at Invesco that we can look back at. We opened up the commodities markets and ETFs a number of years ago, 15 years ago. We also provide exposure to the equities portion of the commodities market. So you can buy a basket of securities that buy, Exxon and Chevron and Halliburton and those names. And yet we still have the direct exposure if you want to buy oil futures or gold. And so both exist because they have different return patterns and different profiles. And quite frankly, they're built for different investment purposes within a portfolio. And so fast forward 10 years, these products will be as relevant as they are today, even as more efficient ways to access the physical currency continues to build.
John, why did you guys decide to put 15% of the holdings in one of these ETFs in the Grayscale Bitcoin Trust? We know Grayscale wants to convert into an ETF at some point as well. Is there any conflict there for you guys?
So both solutions have a 15% investment in a fund that is directly invested in Bitcoin. And we think that to participate in this ecosystem, you need the direct exposure in some capacity. And you also need all of the companies that are building the infrastructure around this. And so if you're really getting a true play on this space, we think that there's a need to have some exposure to the physical currency as well, or to the physical capability as well. And so both Sado and BLKC hold that investment at about 15% of the fund.
So what do you think about the SEC's moves then? There was a lot of talk this week about potentially even seeing an ETF within the next 12 months. Do you expect that to be the case, that we can see pure Bitcoin ETFs sometime soon?
So look, there's tremendous focus on the first Bitcoin ETF, physically holding Bitcoin, and we're working on that with our partners at Galaxy. That's not the final destination, though. Again, if you fast forward out further, we see a full shelf of physical capability, different combinations of coins, different weighting methodologies, again, all providing different return patterns. And look, this is a technology. It's 12 years old, right? And people, think of this space, we all think in terms of years. But if you look at this in terms of the network effects, we're starting to see the financialization of this space as the next network effect. And so there's no question whether there'll be an ETF here at some point. It's just a matter of when.
Going broader, John, in the broader market landscape, what happens when we have a week like this week? Big volatility, then a huge bullish reversal. Clearly, we're exposed to geopolitical stuff like an energy crisis, like the debt ceiling limit. What are you noticing sort of in terms of flows and positioning? And then tie that back into crypto and where it moves with at this time.
Yeah, so you've seen an interesting move specifically in crypto over the last week, kind of diverging from the macro environment with a pretty good rally here from 45,000 up to what we have 54,000 right now. Look, we believe in long-term investing, and the products we build are for the long-term asset allocation. I think the great thing about ETFs is you can buy it long, you can sell it short. There's options available on the product. And so we see so many different investor types utilize these products for exposure. And the flows don't always translate directly into the view in the particular market. So we continue to see strong flows in our commodity range and our broad equity capabilities this year. And that trend is persisting even in the recent weeks with the volatility that you've pointed out.
What are investors using crypto for in this environment? Because it's fascinating to see tech up, crypto down, crypto up, tech down. I'm wondering what purpose it's serving for many of the people that are buying it right now.
Yeah, so we're certainly hearing from investors the interest in this space, and again, that's really what we're responding to with these two equity capabilities, and we've talked about continuing to evolve that product suite. Look, it's really about a return pattern that, as you pointed out, may be divergent from traditional asset classes. This may be, the first new asset class in around 100 years that we're seeing evolve right in front of us. And so there's clearly a play on scarcity. There's an inflation topic. With what we're seeing with the government spending right now, there's a play around that. There's tremendous interest in this space. And what we also see is there's a tremendous need for education And that's what we're most excited about, is partnering with Galaxy and others to educate around this asset class that is quickly emerging.
Really quickly here, are investors souring on growth ETFs right now?
So we continue to see strong flows in some of our growth products like QQQ. It just reached $200 billion in AUM. We're not seeing that trade sour in our ETF lineup. We are seeing increased flows in value, but we continue to see the growth trade in terms of flows into our suite.
Super interesting, John. Thanks very much indeed for your time today. We really appreciate it. John Hoffman of Invesco. Shanali, always appreciate your time as well. This is Bloomberg.
Let's recap the news of the last hour. Senator Chuck Schumer as well as Mitch McConnell saying that there is a debt ceiling deal. They're going to hopefully vote on that today in the Senate. An aide telling Bloomberg that this would let the U.S. meet its obligations through December 3rd, which sets us up for a really rough early December with a debt ceiling limit and a budget showdown again at the same time. Markets, though, feeling the optimism, removing a key risk in the short term. You have yields really pushing higher now, up by about 4 basis points. You're around the equity highs for the S&P, and the VIX volatility continues to sink lower, Guy. But what we learned, for me, is that the debt ceiling clearly does matter because it has an effect on those higher interest rates. Inflation matters too, and supply chains matter, and all of that. But there is a feed through, and the markets do react to that. Just look at the rally over the last 24 hours.
Yeah, I think you can point the rally. You can point at the rally and see different things if you want. You've obviously got what's happening with energy prices. That's a factor. I think the debt ceiling is definitely in there. Thursday, November the 25th. Isn't that Thanksgiving? You guys are going to have a lot of fun at Thanksgiving. Well, certainly the politicians, I suspect, maybe having to curtail some of their plans because we'll be back potentially December the 3rd, worrying about all of this again. The European close, Alex, is coming up next. Nicola Mai, PIMCO, joining us next. This is Bloomberg.